All right, welcome. Today, we're diving into a financial tool that's designed to protect your single most important asset. But, it's something that often gets overlooked. We're talking about disability insurance. We're going to break down what it is, why it's so critical, and how the whole thing actually works.
So, to get us started, just think about this for a second. What is your most valuable asset? Your first thought might be your house, right? Or maybe your car. And yeah, those are obviously big ticket items. But the source material we're looking at today points to something way more foundational. Yeah, it's not something you can physically touch, but it is the absolute source of all your other financial security.
That's right, it's your paycheck. Your ability to earn an income is really the engine that powers your entire financial life. I mean, it pays for the house, it pays for the car, and pretty much everything else. It is the one asset that makes all the others possible.
Okay, so let's really dive into this. If your income is that valuable, then the next question has to be, just how protected is it? The reality of it? Well, it might just surprise you. The research we're drawing from for this explainer highlights a few statistics that are honestly pretty eye-opening. They paint a really stark picture of just how vulnerable that income truly is. Get this, 7 out of 10 working Americans couldn't go a single month without a paycheck before facing serious financial trouble. I mean, that is just a staggering figure. It really shows you how thin the financial cushion is for most people and how one single unexpected event could kick off a real crisis. And what's really interesting here is the disconnect this shows. You have this huge part of the population basically living on the edge, and yet 67% of them, two-thirds of private sector workers, have no long-term disability insurance. That is just a massive gap in the financial safety net. And this brings us to what might be the biggest misconception of all. The data clearly shows that the greatest threat to your income isn't some dramatic on-the-job accident. Nope. 90% of the time, it's the slow burn of a common illness. We're talking about things like cancer, heart disease, or even arthritis. So, if your income is this valuable and this vulnerable, what's the solution? How do you actually go about insuring a paycheck? It's called disability income insurance, or DI for short. The concept is actually really simple. It's a policy that's designed to replace a portion of your monthly income if an illness or an injury keeps you from being able to work. So let's look at a few of the key terms you'll run into with these policies. First up is the elimination period. You can think of this kind of like a deductible, but instead of money, it's time. It's just the waiting period, often something like 90 days before your benefits actually start paying out. Next, you've got the benefit period. This one's pretty straightforward. It just determines how long the policy is going to pay you once those benefits kick in. It could be for a set number of years, like 2 or 5, or it could even be set up to last all the way until you hit retirement age. And this one here, this is a really important one, the own occupation definition. This means the policy considers you disabled if you can't perform the duties of your specific job. So imagine a surgeon who injures their hands. Even if they could technically go work in a different field, they can't be a surgeon, so this kind of policy would kick in. So that's the terminology. But to really see how this all works in the real world, let's take a look at an example from the guide. This is where it all starts to click. So let's meet Stacy. She's a successful realtor, but just like most of us, she has some pretty significant monthly bills that depend completely on her commission checks coming in. Just look at her 3 biggest expenses: the mortgage, the car, and her student loans. That adds up to almost $3,000 a month. If her income disappeared, that would become an impossible hill to climb very, very quickly. And this is where the flexibility of this stuff comes in. Stacy has options. She could get a really comprehensive policy that covers most of her income for about $73 a month. Or she could start smaller with a policy that just covers her single biggest expense, her mortgage, for around $32. And this isn't just for realtors. Take Rebecca, a nurse. I mean, she sees the impact of disability firsthand at work every single day. For her, about $60 a month secures over $2,800 in monthly benefits to protect her own finances. Okay, so you see the need and you understand the solution. But how does an insurance company actually decide who to cover and what to charge? Well, that process is called underwriting. And it really just boils down to 3 main things. First, they're going to look at your occupation, what you actually do all day. Second, they'll verify your income to figure out how much benefit you qualify for. And third, they'll review your medical history to get a good sense of your individual health profile. Now, the occupation part is particularly interesting.
Jobs are grouped into these risk classes. An accountant working in an office, that's a 4A, a much lower risk than, say, a roofer, who's a 1A. And that difference in risk is going to be directly reflected in their rates. Makes sense, right?
So after all that, looking at the risk, the product, the process, what is the key takeaway from this guide? What's really the bottom line here? It all comes down to the simple but really powerful question. We intuitively insure our cars and our homes. It's just what we do. But we often forget to insure the very thing that pays for all of it, our paycheck.
And so we'll end this explainer right where we started, with a question for you to think about. Look at your own finances. If your ability to earn an income just disappeared tomorrow, for a month, a year, maybe longer, what's your plan? It's the one question everyone should really have an answer for.